studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
We've spent the last several sections discussing foreign income, foreign taxes, and foreign tax credits. Now we're introducing another important international reporting requirement, Form T1135, also known as the Foreign Income Verification Statement. Although T1135 is often discussed alongside foreign tax reporting, its purpose is very different. T1135 is not primarily about calculating tax. Instead, it is about reporting foreign property to the Canada Revenue Agency. Let's begin in the center of the slide. Here we see Barnes Dentistry Professional Corporation surrounded by investments and assets located in different countries around the world. The corporation may own foreign stocks. It may have a foreign brokerage account. It may own rental property outside Canada. Or it may hold funds in foreign bank accounts. These assets are examples of what the CRA calls specified foreign property. The key question is not how much income these assets generate. The key question is whether the corporation owns them. That's an important distinction that many new tax preparers miss. Now let's move to the right side of the slide. This is where the CRA filing requirement comes into play. The CRA asks a simple question. Does the corporation own specified foreign property with a total cost amount exceeding $100,000 Canadian? Notice that the threshold is based on cost amount, not market value, and the threshold applies at any time during the year. If the total cost amount of specified foreign property exceeds $100,000 Canadian, the corporation may be required to file Form T1135. That's why the green checkmark appears below the threshold question. Once the threshold is exceeded, a filing obligation may arise. Now let's examine the important rule panel. This summarizes the entire filing requirement. Specified foreign property. Cost amount over $100,000 Canadian at any point during the year. If all of those conditions are met, T1135 reporting may be required. This is one of the most important compliance thresholds in international tax reporting. Now let's look at the examples shown on the left side of the slide. The first example is foreign stocks. These could be shares of corporations located outside Canada. The second example is foreign brokerage accounts. Many corporations hold international investments through foreign investment accounts. The third example is foreign rental property. Real estate located outside Canada may fall within the reporting requirements. The fourth example is foreign bank accounts. Funds held with financial institutions outside Canada may also be relevant. And finally, foreign interests in partnerships, trusts, or other foreign entities may need to be considered. The purpose of these examples is to show that T1135 reporting extends beyond simply owning foreign shares. Many different types of foreign property can trigger reporting requirements. Now let's move to the comparison box on the lower right. This is where many students finally understand the difference between Schedule 21 and T1135. Schedule 21 reports foreign taxes. Its purpose is to calculate foreign tax credits and reduce Canadian tax payable. T1135 serves a completely different purpose. It reports foreign property ownership. In other words, Schedule 21 is about foreign tax relief. T1135 is about foreign asset disclosure. Both forms deal with international activities, but they answer different questions. Schedule 21 asks, how much foreign tax was paid? T1135 asks, what foreign property is owned? Now let's look at the reminder section across the bottom. One of the most important concepts in T1135 reporting is that a filing requirement may exist even if very little foreign income is earned. In some cases, a corporation may own significant foreign assets that generate minimal income. The reporting obligation can still exist. That's why T1135 is fundamentally an ownership reporting form rather than an income reporting form. The flow shown at the bottom summarizes the process. The corporation owns foreign property. The cost amount exceeds $100,000. A T1135 filing requirement may arise. The form is completed and submitted to the CRA, and proper compliance helps avoid penalties and reporting issues. Now notice the final banner. T1135 reports foreign assets, not foreign tax credits. This single sentence captures the most important lesson from this slide. Whenever you hear T1135, think foreign property disclosure. Whenever you hear Schedule 21, think foreign tax credits. The key takeaway from this slide is simple. T1135 is a foreign asset reporting form used to disclose specified foreign property to the CRA. When the total cost amount of specified foreign property exceeds $100,000 Canadian at any time during the year, a filing requirement may arise. Unlike Schedule 21, which focuses on foreign taxes, T1135 focuses on foreign property ownership and international reporting compliance. In the next step, we'll examine the different types of foreign property that must be reported and learn exactly what information is disclosed on a T1135 filing. Now that we understand the purpose of T1135, let's look at the types of foreign property that may need to be reported. This is one of the most important parts of the entire T1135 process because the filing requirement is triggered by foreign property ownership, not by foreign tax paid, and not necessarily by foreign income earned. Let's begin with the misconception shown on the left side of the slide. Many beginners assume that foreign income automatically creates a T1135 filing requirement. But that's not how the rules work. Notice the large, not equal sign in the diagram. Foreign income and T1135 are related concepts, but they are not the same thing. T1135 focuses on foreign property ownership. The amount of income earned is not what determines whether the form must be filed. Instead, the focus is on the assets themselves. Now let's move to the center of the slide. A large umbrella graphic represents specified foreign property. Think of this umbrella as covering many different types of foreign assets. The first category is foreign stocks. These are shares of corporations located outside Canada. For example, if Barnes Dentistry owns shares of a U.S. public company or another foreign corporation, those investments may be considered specified foreign property. The second category is foreign brokerage accounts. Many corporations hold international investments through brokerage accounts located outside Canada. These accounts can contain stocks, bonds, mutual funds, and other investment assets. Depending on the circumstances, they may fall within the T1135 reporting rules. The third category is foreign rental property. This includes real estate located outside Canada. A corporation might own a rental building in another country that generates rental income. Even if the rental income is relatively small, the property itself may still be relevant for T1135 reporting. The fourth category is foreign bank accounts. These accounts may hold cash deposits, savings balances, or other funds outside Canada. Foreign bank accounts are among the most commonly recognized examples of specified foreign property. The fifth category is foreign interests. This can include ownership interests in foreign corporations, partnerships, trusts, or joint ventures. These interests may create reporting obligations even when the ownership structure is more complex than simply owning shares directly. The important lesson here is that T1135 covers a broad range of foreign assets. It is not limited to one specific type of property. Now let's look at the reporting trigger shown near the bottom of the slide. The key threshold remains the same. The total cost amount of specified foreign property exceeds $100,000 Canadian at any time during the year. Notice that the threshold applies to the combined cost amount of specified foreign property. It is not measured separately for each individual asset. This is a critical detail when evaluating filing requirements. Now move to the panel on the right side of the slide. Once a corporation determines that T1135 is required, what information must actually be reported? The first item is the country where the property is located. The CRA wants to know the foreign jurisdiction associated with the asset. The second item is the maximum cost amount during the year. This helps the CRA understand the size of the foreign investment. The third item is income earned from the property. If the foreign asset generated interest, dividends, rent, or other income, that information may need to be disclosed. The fourth item is gain or loss information. If the property was sold or otherwise disposed of during the year, relevant gain or loss details may be required. And finally, additional identifying information may also be reported depending on the type of property involved. Now let's review the reporting flow shown at the bottom. The corporation owns foreign property. The cost amount is evaluated. If the total exceeds $100,000 Canadian at any point during the year, a T1135 filing requirement may arise. The form is then completed and submitted to the CRA. This process is fundamentally about disclosure and compliance. Now let's look at the important reminder panel. There are several points every tax preparer should remember. First, the threshold is based on cost amount, not fair market value. Second, the $100,000 threshold applies to the total specified foreign property owned. Third, the threshold is tested at any time during the year. And finally, even a corporation earning little or no foreign income may still have a T1135 filing requirement if significant foreign property is owned. The message at the bottom of the slide summarizes everything perfectly. T1135 focuses on foreign assets owned, not simply foreign income earned. That distinction is the key to understanding the entire form. The key takeaway from this slide is simple. T1135 reporting is triggered by ownership of specified foreign property. Common examples include foreign stocks, brokerage accounts, rental properties, bank accounts, and foreign ownership interests. When the total cost amount exceeds $100,000 Canadian, the corporation may be required to disclose information about those assets to the CRA through Form T1135. In the next step, we'll bring everything together and see how T1135, Foreign Income Reporting, Schedule 21, and foreign tax credits fit into one complete international tax reporting system. We've now reached the big picture. Throughout the last several sections, we've discussed foreign income, foreign taxes, foreign tax credits, Schedule 21, and Form T1135. At first, these topics may seem separate, but in reality, they are all part of one integrated international reporting system. This slide shows how everything connects together. Let's begin at stage 1 on the far left. The process starts when a corporation owns foreign property. Examples include foreign stocks, foreign bank accounts, foreign rental properties, and other foreign investments. Notice that at this stage, we're talking about ownership, not income. The corporation simply owns foreign assets. This ownership becomes the starting point for international reporting requirements. Now move to Stage 2. The corporation performs a T1135 assessment. The key question is, does the total cost amount of specified foreign property exceed $100,000 Canadian at any time during the year? If the answer is yes, a T1135 filing requirement may arise. This is the first major reporting obligation. Notice that T1135 focuses entirely on disclosure of foreign property. It is not calculating tax. It is not calculating credits. It is simply informing the CRA about foreign assets owned by the corporation. Next, we move to Stage 3. Those foreign assets may generate income. The corporation may receive foreign dividends. It may earn foreign interest. It may collect foreign rental income, or it may earn other types of foreign source income. At this stage, the foreign property begins producing taxable income. Now move to Stage 4. Because the income originates outside Canada, a foreign country may impose tax on that income. For example, tax may be withheld from dividends. Interest income may be subject to foreign withholding tax, or foreign business income may be taxed by another jurisdiction. As a result, the corporation now has foreign taxes paid or foreign taxes withheld. This brings us to Stage 5, Schedule 21. This is where foreign tax information is analyzed. Schedule 21 takes the foreign taxes paid and calculates the allowable foreign tax credit. Using the foreign tax credit rules, the schedule determines how much Canadian tax relief is available. Remember the key principle. The allowable credit is generally limited to the lesser of foreign taxes paid and Canadian tax otherwise payable on the foreign income. Schedule 21 is therefore the calculation engine of the foreign tax credit system. Next, we arrive at Stage 6, Canadian tax relief. Once the foreign tax credit has been calculated, it is claimed on the T2 return. The credit reduces Canadian tax payable. This helps prevent double taxation and creates a fairer overall tax result. Notice the green shield shown in this stage. It represents protection against being taxed twice on the same income. Finally, we arrive at Stage 7. CRA compliance is complete. The corporation has fulfilled its reporting obligations. T1135 has been filed if required. Foreign income has been reported properly. Schedule 21 has been completed. Foreign tax credits have been calculated, and the T2 return reflects the appropriate tax relief. The corporation has now completed the entire international reporting cycle. Now let's look at the mental model shown on the right side of the slide. This summarizes the entire process. Foreign property is owned. T1135 disclosure may be required. Foreign income is earned. Foreign tax is paid. Schedule 21 calculates the foreign tax credit. The credit is claimed, and Canadian tax is reduced. If you can remember that sequence, you'll understand how international reporting works within the corporate tax system. Now let's examine the comparison panel near the bottom of the slide. This is one of the most important distinctions for tax preparers. T1135 reports foreign assets. Schedule 21 reports foreign taxes. And the T2 return reports income. Each form has a different purpose, but together they create a complete reporting framework. Think of them as three pieces of the same puzzle. T1135 answers: what foreign property is owned? Schedule 21 answers: how much foreign tax was paid? The T2 return answers: how much income was earned? Together, they provide the CRA with a complete picture of the corporation's international activities. Now let's look at the example journey shown near the bottom. Barnes Dentistry owns foreign stocks and foreign rental property with a combined cost amount exceeding $100,000. As a result, T1135 may be required. Those assets generate foreign income. Foreign taxes are paid. Schedule 21 calculates a foreign tax credit, and Canadian tax payable is reduced. This example demonstrates how every part of the international reporting system works together. The benefits panel on the right summarizes the outcome. Proper reporting helps satisfy CRA requirements. It reduces the risk of penalties. It ensures appropriate tax relief. And it supports transparent international reporting. The final banner captures the entire message of this section. T1135, Schedule 21, and the T2 work together to report foreign assets, foreign income, and foreign tax relief. That's the complete international reporting system. The key takeaway from this slide is simple. International tax reporting involves more than just calculating tax. Foreign property ownership may create T1135 reporting requirements. Foreign income may generate foreign taxes. Schedule May 21st provide foreign tax credits. And the T2 return ties everything together into one complete compliance framework. With this final diagram, you now have a complete roadmap of how foreign assets, foreign income, foreign taxes, and tax relief interact within the Canadian corporate tax system.